You don't cheat the market. You don't get more money by just buying life insurance and then dying soon. Insurance is not an investment. The odds are in the insurance company's favor. Welcome to How to Retire on Time, a show that answers your retirement questions. My name is Mike Decker. I'm a licensed financial advisor and fiduciary. And with me in the studio today is my colleague, David Franson, who will be reading your retirement questions. As always, you can submit those questions to 913-363-1234. Again, that's 913-363-1234. David, what do we have for today?
Hey, Mike, what's the best way to get funds into a Roth IRA? And do you just click a button and they move over?
Yeah. So I want to open up the conversation more than just Roth, but let's just talk about tax-free in general. So there's kind of a couple of categories that I would consider the tax-free category to be in, and it's slightly nuanced, okay? So you've got a Roth IRA, Roth IRAs, or the after-tax part of your 401k or 403b or whatever. Basically, it grows tax-free, as in it grows without being subject to capital gains tax.
Okay.
And then when you take it out, it's tax-free. It doesn't hurt your provisional income or your Social Security calculations. It doesn't hurt your income taxes and so on, okay? So that's one way that you can operate tax-free. And people love it because it's the easiest to do. It is difficult, though, to get funds into a Roth because you have to be working and you have to make within a certain threshold, and you may not qualify for Roth. And then you've got these other things to get money into Roth, and let's just briefly go through those. You've got your Roth contribution. You've got your IRA, your backdoor IRA to Roth, so you can put funds into an IRA and then do an IRA to Roth conversion. And then you've got your backdoor or your mega backdoor, which is through your 401k, which is kind of another way that you could do this, okay?
Okay, I'd never heard mega backdoor before.
Yeah, it's not really common. I don't want to spend too much time on it. If you wanted me to talk about it more, just text us that question. Hey, Mike, explain the mega backdoor Roth. That's a pretty black and white definition that you could probably ask ChatGPT to or Grok or whoever you use.
Okay.
But let's just, generally speaking, when you're working, you should be able to get funds into a Roth in one way or the other. Now, retirement accounts or qualified accounts, these are accounts that are not subject to capital gains, whether you're getting money into a Roth or an IRA. It's very beneficial. There's a huge benefit to these accounts. But you have to ask yourself, at what cost? So we get many very successful people that are earning $250,000 to $400,000 household income that are saying, everyone says I should get money into the Roth, or I should do the backdoor Roth or the IRA Roth. The Roth is where funds need to go. And I say, okay, what's your adjusted gross income? Or your modified adjusted gross income, depending on the situation.
Okay.
And then what is your what's your tax bracket? And they'll tell me. I'll say, okay, would you like to pay that or potentially more, depending on where they are, just to get funds into a Roth right now? Or let's look at your adjusted gross income when you retire. Would you rather pay that percentage on the conversions? And almost every time they sober up and say, well, it's like they let go of this FOMO, the fear of missing out, because everyone else is putting funds into Roth. And they're deferring their income tax, putting it into their IRA, and then they're going to put funds into Roth later. So there's an important understanding of the environment in your tax situation and the sequence of how to get funds into the Roth.
Yeah, because anytime you put, how do I want to say it? It's income, right? When you're moving from a traditional IRA to a Roth, that's income.
You're paying income taxes.
Yes.
So at what tax bracket, or in my opinion, a more appropriate measurement, what's the effective tax rate of you moving those funds over?
Okay.
How does that change your dynamic environment? Does that affect your health care? If you're on Medicare, is that going to put you into IRMA? Are you okay with that? Are you going to do it for a limited period of time? Are you not going to do it for a limited period of time? Are you on Affordable Care Act because you retired before 65 years old? All these questions matter, okay? So you don't want to be like, I don't know, are those lemmings that just run off a cliff because other lemmings fell off a cliff or whatever? Is that the right expression?
Yeah, that's right.
If you want to go online, this would be a fun webinar to do. I don't know if we'll do it or not. But just going on Reddit and just finding threads and then explaining why they're idiots. Now, I want to defend Reddit.
Yeah.
Half them are self-proclaimed philosophers that believe they're financial wizards, and the other half are brilliant financial advisors. Like they actually know their stuff. But to the uninitiated, they both probably look the same. And that's the problem. How do you differentiate the two? I mean, that's like me going on the medical forums and trying to figure out what is right. You know, let's step on a landmine right now. Let's talk about vaccines for a second.
Oh,
Can we talk
yeah.
about that?
Can't wait. Yep. Let's do
I'm
it.
not a medical professional. Do you think I could properly sort through the medical research on if that's good or not?
Yeah, it'd be tough.
I'm not qualified to do that.
Yeah.
That's kind of how I like to envision someone who doesn't have a financial background trying to figure out how to proceed with all of this. You have no idea how to differentiate the differences, and you could put it into ChatGPT, but ChatGPT is going to give you the most predictable answer it believes it's supposed to give you. It's not actually doing research, and for all those who don't know, large language models take the information that's in there, and whoever has the loudest voice or the most popular form, it's going to influence the answer that it gives you. So it's a tricky one. It's a really tricky one. So when you have this idea, how do you get funds into a Roth? You have to first ask yourself, is Roth the next step, or should you be putting funds into an IRA and then put the funds in the Roth later? Can you even put funds to a Roth? And by the way, this is an important distinction on Roth contributions versus conversions.
Okay.
So a contribution is when you take after-tax funds, like your checking and savings account, and you add it to a Roth account. If you're able to do that and you add to a Roth account, there's around a 5-year holding period. You can't take the funds out.
Okay.
Okay. If you do a conversion, dollar for dollar, you can take those funds out.
Oh.
The 5-year holding period is only based on the gains of those assets. So you have to do a proper accounting of how the funds are moving. But people misunderstand that as well. So there's different ways to move the funds over to the Roth. Now, there's other tax-free ways that you could also consider. One of them being municipal bonds. You're not going to make as much money probably with municipal bonds for the growth potential, but you probably won't lose as much money. But that's a tax-free source that there's no limit. The sky's the limit. So the ultra wealthy might use municipal bonds just to try and lower their overall cash or taxable situations for a period of time. Should someone with $20 to $30 million just go all in on municipal bonds to avoid taxes? I don't think that's prudent. I see a lot of people do it, but I just don't think it's prudent. Because what's the end goal? Is it just to sit in municipal bonds and just call it good and to suspend critical thought? Or is it to be industrious with your money and prudent with your money and grow your money in different ways? And so that's got some heartburn with that. Now, the insurance industry is going to propose what's called an indexed universal life insurance policy. All life insurance, technically, it grows tax deferred or tax free because you're not creating a taxable situation as the money grows.
Okay.
You can borrow against the policy tax free because you're not taking income out, you're not taking cash out, you're borrowing against the policy tax free. That is a true statement. And then whenever you pass, the death benefit will then pay back the loans on the policy and then pay out the beneficiaries allegedly tax free. Now that depends on your estate, and does the benefit go to your estate, and does that cross over an estate tax exemption? I mean, there's different ways that could create a taxable situation or not. So be very careful with how you structure your estate plan and any life insurance benefits. It's not as cut and dry as people assume. But going back to the life insurance side, insurance is not an investment.
I think I've heard you say that before on this show.
Insurance is not an investment, but there is a cash vehicle associated with these policies. It's not like term life insurance. And so when you get people online or on TikTok or on the radio saying, you know, this is how you cheat the IRS is through indexed universal life insurance, and that's how the Rockefellers did it, and that's how you should do it too, and this is how the wealthy do it. It's not. I'll tell you right now, when I work with someone that has 20 million plus, and we're talking about their planning, and I will jokingly say, all right, we got to talk about life insurance. Do you feel that you need to get a death benefit? And they laugh. And I say, I thought so. And then we move on. Okay. Maybe they do it for because there's some sort of risks they want to pay for to hedge against. I see that. But the rich aren't cheating the IRS by growing their cash through life insurance. If they buy life insurance, it's for a certain specific time frame that if they died sooner than they expected, that's going to help cover some potential illiquidity or other issues on passing their estate. You don't cheat the market. You don't get more money by just buying life insurance and then dying soon. If you're on your deathbed, they're not going to insure you. So the odds have to be against you for the death benefit to work out. Okay. And this is, I cannot say this emphatically enough. I get probably the most pushback from insurance agents, whom I am an insurance agent, technically speaking, and from the ultra wealthy who were sold this idea that life insurance is how they solve their estate planning issues and their estate planning tax issues. And there's this visceral resistance. I mean, almost like they're foaming at the mouth, just like, no, I wasn't lied to. Well, let's just run the numbers. Here's the different times where it would make sense, and here's when it wouldn't have made sense based on these average projections. The insurance company isn't printing money to give you a larger death benefit. They're not cheating the stock market, and you aren't either. Life insurance is paying for a death benefit so that if you die sooner than expected, knowing that the odds are in the insurance company's favor, yeah, you might get a nice ROI. Yeah, that can bridge the gap when it comes to businesses being illiquid, or maybe things aren't settled in the right way for the estate tax purposes, whatever it is, and you're willing to pay to hedge against that risk. But you're not getting rich off of life insurance. Life insurance is a great way to hedge against that, to hedge against spousal risk if a spouse were to pass sooner than expected, hoping that your spouse doesn't pass. Or maybe, I'm going out on a limb here, maybe you're taking the bond fund component or the lower risk part of your overall plan in the portfolio, because most people aren't all in stocks. They've got some lesser risk assets that aren't growing as much as the S&P, but they're not losing when the S&P goes down. Maybe you take some of those assets and you structure an appropriate indexed universal life insurance policy so that the cash value hopefully advances at an equal or near rate as the cash value would have done with bond funds, depending on how the portfolio was done, and you get the death benefit. That is a reasonable probability or possibility. That is a reasonable, in my opinion, thing to look for. As long as you're okay paying for the death benefit, as long as the insurance policy is structured, as long as it makes sense from a funding standpoint, because you're probably not going to make much money for 10 years in doing this. This is a long-term play. There's a lot of, as long as you're okay with fill in the blank situations. Sometimes it makes sense. Sometimes it doesn't. But let's not tell everyone that everyone should do the same thing. Let's get into the details and understand what's going on. But that is another vehicle that you could funnel money into that would grow tax-free and help shelter potential tax issues. It just depends on your situation. Hey, thanks for watching this video. Make sure that you like and subscribe first, and then go to www.retireontime.com to grab a copy of my book, How to Retire on Time, take a few courses about retirement, join my newsletter, and so much more. Now, if you want to work with one of our advisors here at Kedrick Wealth who can help you put together a retirement plan that's designed to last longer than you, just click the button, Get Started. Everything we do is intended to help you retire on time. We hope you enjoy, and we'll see you in the next show.